Hey everybody, welcome back. My name is Reagan Prescator. I'm a sales representative at Royal LePage Performance Realty and a buyer's agent at Schurter and Associates Ottawa Real Estate Team.
And I'm Michael Schurter, real estate broker at Royal LePage Performance Realty, and the team lead here is Schurter and Associates. We're joined today by Reni McNeil. We're doing a bit of a segment on mortgages that she's been helping out with. And as our clients know, about 30% of the business that we do at Schurter and Associates is real estate investment. So we figured we'd do a little segment on real estate investment from a financial perspective since we have Reni here to help out. Reni, can you tell me a little bit about the mortgage rates on rentals versus if you're buying your own single family home?
Yeah, absolutely. So it kind of comes to a surprise to a lot of my clients that the 5-year fixed rate or 5-year variable rate, whatever type of term you go with, the rate offers are always slightly higher on a rental property than a primary home. The reason being for that is because the lenders see them slightly riskier. So there's always a vacancy aspect that they have to take into effect, as well as tenants might not care for the home as well as the owner would. So there's a little bit of a higher risk. So the lenders add a bit of a premium to the interest rate.
And what about with a down payment?
Down payment. So with a rental property of any kind, you need a minimum of 20% down, which is, quite a bit higher than the minimum of 5% that you would need if you're buying your primary residence or like a cottage home, a secondary home for yourself.
Yeah. And so to help make up for the ratios, because you still have to qualify for the borrowing ratios, are you able to use rental income from or prospective rental income from a property that you're about to buy to help you qualify for it?
Yeah, absolutely. So there's a few different ways we can use it. If there's already a tenant in the property, we can use the existing lease agreement that they have. If not, we can get a report done. We call it a market rents report, where it's an appraiser will go in, they'll review the property and give us an estimate on how much that property could be rented out for on a monthly basis. And we use
So,
usually, quick rule of thumb is we use about 50% of the rental income to help qualify for the mortgage.
so is there a difference then if they're renting that property to family?
Yeah, for sure. I find a lot of our lenders aren't too keen on having lease agreements with the family in there. Probably more so because, if mom and dad are renting from you and all of a sudden they stop paying their rent, you're probably not too likely to kick them out on the street. So they like to have something that's more of a third party to ensure that that rental income is going to keep coming in.
That makes sense. And so, is there a number of rentals until they can't do this anymore? Like, is there a system in place to make sure they're not just buying hundreds of them based on the rent?
Yeah, for our A lenders, which are, the big banks and a lot of other lenders as well that kind of give the best rates, it's normally five. Five's kind of the max. After we get to that five, it gets a little bit tricky. For instance, I have access to over 60 different lenders that I use. And out of those 60, I have one that will look at properties that hold more than five rent or clients that hold more than five rental properties.
So then what if they're buying it as a corporation?
Same thing. It gets a little bit tricky with the corporation name. Again, it's the same scenario. Out of my over 60 lenders, I have one that will do a mortgage in a corporation or a holdco name on the A side of lending. We do have a number of lenders on the B side that will do it, but then those interest rates are a little bit higher, and there's also some lender fees that are associated with those type of mortgages.
Awesome. And I know with a lot of our investor clients, they have such a good deal that in front of them that they can't turn down, but they probably don't qualify on the A side. Can you tell me a little bit about the B side or the private lending field?
Yeah. So B lending, they're a little bit more lenient on the approval ratios. So the amount of income versus debt that we need to stay in guidelines. And they're really more focused on the property itself. So that's what they're basing the mortgage off of. They have this asset to secure. So they're a little bit more lenient on what they can approve. You're going to see rates probably anywhere from 0.5% to 1% higher on the B side of lending than you would kind of with our A lenders, as well as a fee. So that 1% fee normally is pretty standard. So whatever the mortgage amount is, you're going to get charged a 1% fee on that as well with the B lender.
Yeah. And sometimes that 1% fee is really worth it if you've got a great deal in front of you. So I totally understand why
Mhm.
people would go for that.
Yep.
What if they don't qualify on the B side? Tell me a little bit about the private lending.
Yeah, private lending or alternative lending we use a lot. And basically it's just, there's very little regulations and guidelines that we have to fit in. As long as you have 20%, some lenders, I am able to go as low as 15% down payment. The interest rates on those, again, are going to be a bit higher than you're going to see on the B lending. And the lender fee is going to be a little bit higher as well, because they're taking on a greater risk. They're taking on a risk that, an A lender or a B lender won't approve. So they need to associate that risk and make sure that they're still earning money for their investors as well, and making sure that it's a little bit more difficult to get in and get approved. So they want to get that money back to their investors.
No, that makes total sense. Are there any buyers or investment buyers that you'd recommend go private versus not go private, or maybe it's not worth it because they are explicitly that much more of a risk?
No, I mean, I don't think I'd recommend more one way or the other. It's if it fits a situation for the client and it still makes sense at the end of the day that they're going to make money on this income property, then I recommend it, because there's not many investments that are increasing as quick as real estate is these days.
Absolutely. Awesome. Well, thanks for answering some questions for us, Renee. And I think this is really helpful for anybody looking at investment property, whether it be their first, third, fifth, or up to seventh.
Yeah, thanks for being here, Renee. And as always, if any of you have any questions, feel free to leave them below. We'd be happy to answer them. See you next time.
Great.
Thanks.